Welcome back to Fox Eyes on the Hill Live this Sunday morning. You know, the Federal Reserve has raised interest rates again as it tries to get a handle on inflation. But raising these interest rates also complicates the banking crisis, which began when the Silicon Valley Bank collapsed. How does this impact you, and what could you be concerned about down the road? We want to welcome in Gerard Comizio. He is a professor of banking law at American University, a former banking regulator. Good to see you. When people see lines at a bank and when they see these scenes of people trying to get their money, it's worrisome and it's troubling. How much is this a canary in a coal mine, and how much of this is an isolated incident?
Well, Tom, good to be here. That's a good question. Look, the thing that folks should understand is that, deposits are insured up to $250,000. And for most Americans, the median average deposit's about $5,000. So for most Americans, they're well covered. The problem with Silicon Valley Bank and the recent failures, there's a lot of laws and regulations at issue, but the most important law at issue was Murphy's Law. Everything that could possibly go wrong went wrong at these banks, and there were a number of red flags that all spelled disaster.
Now, we look back to 2008. We look back to the savings and loan crisis. There were a lot of reforms and a lot of changes that were put into place to prevent that from happening again. Are we seeing that people were asleep at the switch here, or is this a unique set of circumstances? We had heard that Silicon Valley particularly was, heavily into startup businesses and startup companies that really were not proven entities.
Yeah, it's a good point, Tom. I mean, Silicon Valley Bank was a good example of just a lot of red flags and everything going wrong. They were concentrated on only one industry. They had a very high level of uninsured deposits, almost 90%, very abnormal level, explosive growth in 1 year. And as a result of that explosive growth, they weren't able to lend all the money out, so they bought government securities, which they bought just about the time when it became very interest rate sensitive because of the Fed raises. And next thing you know, they're booking losses, depositors are withdrawing money, and the bank's between a rock and a hard place. They can't sell the securities because they'll take big losses. The stock price goes down, and it becomes a self-fulfilling prophecy. People started to withdraw their money.
So they blow up this balloon and it pops in their face, essentially.
Something like that, absolutely.
So for the average folks who see this, and, there were other banks that had some problems as well, too. Should people be concerned about their banks? Are there things that they should be looking at their own banks right now to make sure that their bank is not replicating any of these mistakes?
Well, that's a good question. And I think the government, in some respects, has to present the issue to the public, because here's what depositors know. They know that money is definitely, first of all, money is definitely been moving in recent weeks from smaller banks to bigger banks. All they know is during the financial crisis, the big banks were protected, so they know that's a safe bet. The government has to make sure they're showing them and telling them that regional and community banks are good too, and you shouldn't be moving your money out, especially since some of the money has been moving to odd places like crypto and things that are not insured, like the stock market and money market funds.
Now, we know the Fed has been raising these interest rates to keep inflation low, and they continue to do that. How long do you expect that to go on with, the Fed stepping in and, raising these rates in the hopes of cooling off inflation?
Well, good question, Tom. Since it's almost baseball season, Hall of Famer Yogi Berra one time said it's hard to make predictions, especially about the future. That's a good question, but the Fed is between a rock and a hard place here, because they're in charge of the monetary policy and raising interest rates, but they're also in charge of regulating banks. And right now, there's some real questions about what is the exposure of other banks to the securities investments that they've made, and what impact is that going to have on the U.S. economy, the financial system?
And this continues to make the street uncomfortable.
Absolutely. And I think, the question is, what is the reassurance in the coming weeks and months? How is the government going to make sure that they understand that small banks are still protected.
Gerard Comizio, we appreciate you, banking law professor over at American University. We'll have you back real quick because I don't think we're done talking about this.